Okay, so good evening, everyone, all across the country. My name is Andrea Martin Marcelo, and I'm an accounting articling student here at BDO. It is my pleasure to welcome you to the Tax and Wealth Accumulation webinar that is jointly hosted by BDO and Richardson Wells. Some administrative things to mention before we start. We want the session to be as interactive as possible, so feel free, more than free, to raise your hand, type questions on the Q&A, to turn on your camera, whatever you feel comfortable. You can also just unmute yourself as well. There's also going to be a recording available of this session, either through Teams or a YouTube link. And now to introduce our lovely speakers. So to start, we have Richard Wong, who is a senior manager in BDO's Vancouver Private Enterprise Group, who specializes in providing tax and accounting services to small businesses and professionals. Richard qualified as a CPA CA in 2010. Next, we have Kenneth Wu, who's also a BDO. Kenneth is a partner in the Business Services and Outsourcing Group with over 20 years of experience in tax and accounting services to private enterprises. And then we also have Ethan Dang, a senior portfolio manager and investment advisor with Richardson Wells. Ethan works with high net worth families and corporations to provide holistic health management services. He's obtained the CPA designation for investments in 2015 and the CFP for financial planning in 2021. So now I'll turn it over to Ethan to continue with our presentation.
You're muted, Ian.
Sorry, Ethan.
Sorry, mistake 101. There you go. Got it out of the way. Thank you, Andrea, and welcome everyone. We appreciate your time in joining us this evening. We are super delighted to share what we have prepared for you. I also want to take a moment to thank Kenneth and Richard for the idea of putting on this webinar. Here's our agenda this evening. What you'll see is that we'll start with an overview of holistic wealth. Then I'll pass it on to Richard and Kenneth, and they will do pillar number 2, which is on tax and accounting. Then I'll come back to walk us through effective portfolios and protection strategies. We have lots to share with you tonight, so please feel free to jump in with questions. Next slide, please. When it comes to holistic wealth, there are 3 pillars. The first is wealth accumulation to be able to achieve your financial goals. It comes in 2 forms. It's from your savings as well as the investment growth of your portfolio. Pillar number 2 is tax optimization, meaning you want to keep as much as you can from what you make. And then thirdly, it's about putting on protection in the form of insurance, because sometimes life throws us curveballs, and so we want to be able to have protection strategies to protect ourselves and our loved ones. And together, we call this holistic wealth. So for many in the audience tonight, taxes and corporate structure are top of mind. So we will do pillar number 2, tax and planning first, tax and accounting first. Now, I want to end off this introduction by saying, if I was to give you a reason for why you're here tonight, it is for you to gain awareness, knowledge, and access to the strategies that we will discuss in each of the 3 pillars so that you and your family can benefit from a truly integrated holistic wealth solution. So with that, it's my pleasure to pass it on to Richard and Kenneth to do their section.
Thank you very much, Andrea and Ethan, for the wonderful intro, and thanks, Andrea, for getting the boring stuff out of the way. So Kenneth and I are going to talk about the first pillar, or actually the second one, tax and accounting. And this is our disclaimer. And I am going to begin tonight with a case study, Consistent Christine. See, we have very creative names, and actually credit goes to Ethan for this. So Christine is actually very indicative of a lot of the clients that I come across. She's a successful mid-career, professional. She earns a high income and, is fiscally conservative. She, doesn't spend beyond her means and has finally been able to purchase her first home. And now she has started savings, to have savings, hopefully enough for retirement. The issue right now that Christine is having is that she is struggling to have much funds left after tax to invest. Feels like for every 2 steps forward she takes, she takes another step back because, it feels like this, CRA is always having a hand in her pocket. She's also looking for a suitable long-term, investment approach, hence why she is called Consistent Christine. So today I am going to talk about, incorporation as a strategy to optimize taxes, how one can pay themselves from the corporation, what happens if they exceed the magic number of 500K of income, and also, various methods of holding your investments, like holding companies. And Kenneth will also talk about what will happen when your corporate income exceeds 50K, because there are some ramifications there. And also, please feel free to raise your hand, ask in the Q&A. Andrea will raise it. I'm happy to take up questions as we go through my section. So please don't be shy. You can even turn on your video. So incorporation, you guys hear about it all the time. And there are a few reasons. The first reason is tax deferral. So in the case of Christine, who is currently self-employed, all her earnings, net of expenses, are fully taxed in the year earned. And because she's at a high income, there are high tax rates in the upper brackets. So over about 250K, your tax rate is 53.5%. So more than half your income has gone to the government, hence why she cannot save too much money. If she were to incorporate herself, the first $500,000 of business or professional income is taxed at 11% here in BC, 12% in Ontario, so each province differs slightly. And I do want to say this applies to only active income, not investment income. And she would only incur additional personal tax on funds that she withdraws from the corporation. And I do want to point out that the 500,000 actually is shared between groups of companies or even members of a partnership. So let's do a schematic. I love diagrams. So right now, Christine, being self-employed, assuming she earns at, let's say she earns $350,000. She needs $250, for personal uses like paying her mortgage, going on vacations, eating out, and so forth. So to save 100K, she would only have 46K left to invest after tax, which is not very much. So now, if she were to set up a corporation, on the 100,000 that I'm talking about that she will save, she will have 89,000 left to invest, which is, much better than 46,000. And this assumes that, she gets the full, 500,000, small business limit, which I will talk about, in one of the next slides. And she would only pay personal tax on the amount that she withdraws. So I do want to point out that incorporation is tax deferral, not minimization, because when you pull out the funds, there will be additional taxes paid. So therefore, this is ideal for high earning professionals, those over 200K and above, whose earnings exceed the personal expenditures. Those who earn more than they spend. And like I said, you want to discuss with their accountant why, whether it's worthwhile, because there are costs such as, accounting, legal, bookkeeping, they all have to make sense. There could be other reasons why, which I won't, go into too much depth, like liability protection from creditors and so forth. So again, this is a very holistic, you have to take a holistic look at this, as Ethan has mentioned. If you're a US citizen, you want to be careful. There are, the IRS will want their share of the pie, so you want to check with your accountant first. I personally don't practice in US tax. It is a very specialized field, and our firm BDO has a department that specializes in this area. The next reason for incorporation would be income splitting. And as all of you probably know, in this country, the higher the income you are, the higher the tax rate bracket will be. So incorporation, allows you within the rules to allocate income to family members who are on the lower tax brackets and therefore pay lower taxes. And they can be paid salaries or dividends, which I'll talk about in the next slide. I do want to point out that since 2018, there are rules requiring the amount of dividends to be paid to be reasonable. So basically similar to what you would pay an unrelated person. However, there are some exemptions. For example, if the main shareholder is over 65, say in retirement, there are no, limits. And say if the family member at the lower bracket is working 20 hours or more per week. So for example, if the spouse is working, as like a practice or firm manager, a dental or medical or law firm, they would be, exempt from this measure. So you guys all know what a salary is from your jobs. So
sorry, Richard, just to clarify here a question. I think they just wanted to go back to the previous slide.
Okay.
We got a question from Jurag
for,
is it US citizens or also US residents?
It depends. So the question is whether it's a US citizen or US resident. Thank you, Andrea. It depends on the taxability and the tax consequence of it. I think if you're a green card holder, you would be taxed the same way. It is something, we need to take a closer look at. And like I said, if you want, feel free to reach out after. So like I said, it depends. Green card holder is included. Kenneth?
Yeah, maybe just to add, if you are subject to the filing requirements, in the US, generally, if you do own a corporation in Canada, it will be impacted.
Yeah. So it would apply to US persons and citizens. Okay. Thank you. Okay. So a salary is treated as an expense to the corporation. So there's no corporate tax. However, this means that full tax is incurred personally. You also have to deduct and remit CPP for self-employed and also taxes to the CRA. EI is exempt if you own, your corporation. And there's many reasons why you want to do this. For example, if you want to contribute to your RSP, you want RSP room here in BC. The the Doctors of BC, there is a RRSP or TFSA matching program. That could be one way, the reason you want to do this. You also need salary income to deduct childcare expenses. So that's another reason why you would use this. Dividends. Dividends can only be paid to shareholders, and dividends incur corporate tax. And you're going to be asking me, aren't you paying tax twice, in the corporation and the person? Well, the answer is no, because the Canadian tax system gives you dividend tax credit to offset the corporate taxes paid, so there's no double taxation. And therefore, it is a bit simpler because you don't have to make payroll remittances. So 500,000, why is that the magic number? Well, every company, every company or group of companies has a threshold of 500K, and that's of active income, business or professional income, that's taxed at the low rate of 11% in BC, 12% in Ontario. It depends on your province. So you can see there's a big, tax deferral advantage. I do want to point out that this is shared even with members of a partnership or a group of companies. So you can't set up multiple corporations to get around this. And if you exceed the 500,000, your tax rate will be 27% here in BC, 26.5% in Ontario. Again, depends on your province. So your deferral will just be a bit less. And now I'm going to pass it to my colleague Kenneth, who will talk about investing in a corporation, like how you want to structure it. Because now Christine has more income left, and we need to make sure that she doesn't hit some taxation pitfalls. So take it away, Kenneth.
Yeah, thank you, Richard. So yeah, keeping with the example of Christine that we have here, assuming that Christine has incorporated her professional practice and she is doing well and she has accumulated lots of extra cash in the professional corporation, but she doesn't need all that extra cash herself personally, but she's thinking about wanting to use that extra cash and do some investment. Then using a holding company, there could be quite a few benefits. This is what I'm going to talk about here. Now, what she could do, if you look at the diagram in the slide here, is she could set up a Christine Holding Inc. and add that as a shareholder of her active corp. And then once that's set up, she can have the active corp lend or do a dividend to the holding company. And then the holding company will have the cash, to invest. The fact that the active corp is lending or paying a dividend to Holdco, generally, there should be no tax consequences. Unlike, when in the case where whenever a corporation pays anything or lends anything to an individual, there are usually some personal tax consequences that you have to think about. Now, then given this structure, one benefit is that Christine could now do investment activities at the corporate level without attracting the personal taxes right away. And also, I think generally, from what we understand, is that generally, and a lot of the professional corporations, they wouldn't allow investment activities in them. So this way, the benefit is they can, keep the after-tax corporate profits at the corporate level without attracting the personal taxes. and do the investment. Now, another benefit is enabling the use of what we call the lifetime capital gain exemption. So currently the lifetime capital gain exemption is at 1.25 million, and essentially is if you sell the shares of a qualified small business corporation, the gain that you realize on the sale of these shares could be exempt from tax up to 1.25 million. So it's a great exit plan, and we have helped some dentist clients, using the capital gain exemption for their exit, for their retirement. Now, but the Holdco, I mean, could be also quite key to this, to the use of the capital gain exemption, because one of the major requirements is that the active corp, it cannot have significant investment assets in them in order to be eligible for the lifetime capital gain exemption. So by having the Holdco, which holds all the investment assets, and you have the active co that really you had only the active business assets and earning the operating income and paying the operating expenses. This allows you to claim the lifetime capital gain exemption down the road if if you're able to sell the shares of the active corp. That's another important criteria. And the third benefit is liability protection, because the active corp, could be exposed to potential lawsuits and claims. And by having the extra cash and the investments in the holding company, the assets in the holding company are not directly exposed to the business risk, and they are protected at the Holdco level. So that would be the third major benefit. There is some cost, to using the Holdco structure, because, I mean, of course, there is an extra corporation, and maybe if Christine, or if you're thinking about also different investments, you may have other sister and brother companies, in the whole structure. So there would be increased compliance costs, and there also the corporate structure is going to look a bit more complicated. But generally, our experience is that the costs would usually, the benefits actually would outweigh the costs. So, yeah. So next slide, please. Yeah. So, and I think also, assuming that, let's say we are now at a level where Christine has incorporated her professional practice, and she also has set up a holding company for her investments. Now, and what you need to watch out is that so Christine's corporations are earning both business income and investment income. And if the investment income is over 50,000, then there's something you need to watch out, because and also the investment income that we're talking about here is net of all the expenses applicable to the for the investment for the investment. So we're talking about really the profit, from the investment. And if it is for every dollar that is over the threshold, over the $50,000 threshold, you are going to lose $5 of the small business deduction. So say, for example, if the investment income after deducting all the expenses is 100,000, then it is 50,000 over the threshold. And if we take that and multiply by $5, that means it gives you 250,000. And that means Christine is going to lose half of the small business deduction available, because the maximum amount you can get is 500,000. But because of the amount of investment income that she has in the Holdco, she's going to lose half of that. And if it reaches to 150,000, And just by doing the same math, you take it's $100,000 over, and we multiply by $5, so 500,000 there. So it would completely grind the small business deduction, and there's nothing left available to be used. If you find yourself in this situation, where the business is doing well and the investment is doing well, and you lose a small business deduction, it might not be a bad thing because you are, making good money, both active and inactive. And also the good news is that if you're in this situation, there are other strategies that we can come up for you to help you achieve some tax savings or tax deferral. And some of maybe the more quick general ones would be TFSA, the tax-free savings account, the RSP, registered retirement savings plan, and also some life insurance solutions, which Ethan will talk in a bit more detail later. So I think we have a question period before Ethan's going to talk about the investment management. So yeah, just wondering if there are any questions, from the floor at this point.
We can also take on questions at the end too. So if you come up with any, we can answer them at the end. If no questions, none, Andrea, otherwise I will pass the floor over, actually back to Ethan.
Actually, I had a question.
Okay.
Yes, please.
So I wanted to go back to the 500,000 threshold that you showed earlier. Is it per active corporation, or do they sum it up across all the corporations?
Hang on, I'm just gonna share my. Sorry, can you come again?
Yes, so let me go back to the slides where you mentioned the $500,000 threshold.
Right here.
Yes, right here. So is it per one active corporation, or do they sum like all the active corporations under your name?
So the 500 threshold applies to like a group. So if you own, two companies, the two companies have to share that 500.
Oh, okay, that makes sense.
Yeah, and then, the rules are rather complex, like it can be complex, but basically think about anything under common ownership. Or
okay.
if it's like a husband and wife, if you have two different companies, when you have cross ownership over 25%, for example, they have to share. So we have to be very, very careful with that. Does that answer your question?
Yeah, it does. Thanks.
Okay,
Makes
thank
sense.
you. Christian?
That's that's only if it's active income amongst those companies, just to be clear, right?
Correct. It has to be income that is, if your business income, whatever a business does. If you pay, so in Kenneth's example, if you pay rent, from the active company to the holding company, which holds the rental property, that also counts as active, but active income only. Any other questions?
I have a question for Kenneth.
Okay.
I wonder if, for example, a family business from Europe wants to expand into Canada, is it usually better to create a like Canadian subsidiary owned by the foreign parent, or is it better to introduce a Canadian Holdco structure?
Yeah, so there's not a quick answer because one major reason is that Canada has a tax treaty with different European countries, and some are better than the others. And can say that Luxembourg is one of the best ones available. But other than that though, in general, if we do have businesses from Europe, expanding into Canada, quite often we would use a Canadian Holdco at the top, and then we would also set up, various subsidiaries for the operating business down below the Canadian Holdco generally. And also there's usually quite a bit of tax planning that happens really between the Holdco and the European parent, and that's where a lot of these international tax rules and tax treaties, come in.
Yeah, and I do want to add that the 500,000 only applies if the company is Canadian controlled. So if it's a foreign controlled corporation, the 27% or 26.5% rate applies. So it depends on who's controlling the corporation.
So yeah, so anyway, hope that give you a sense of, hopefully give you a general answer. And I think really to give you a better answer is really need to see understand the business, the country, and the expected profit, a lot of variables, and we can help you with a plan.
Okay, sounds good. Thank you.
Yeah.
Thank you. I'm going to turn this over to Ethan. So.
Great, thank you. Great questions, by the way. So thank you, Kenneth and Richard. Let me just share my screen over here. All right, I am sharing. Can you confirm whether you can see it properly?
All good, all good.
Perfect. Okay, so Richard and Kenneth have so far talked taxes and income considerations. We've basically talked about pillar 2. So now I'm going to dive into pillar 1 and pillar 3, where I will invite Richard back at the very end to talk about protection strategies. And I'll take questions at the very end. So here's our disclaimer. Before I dive into my section, I do want to share a little bit of background about myself, just to give you context. Prior to coming into the industry of wealth management, I was an engineer. So for many years, I practiced as an engineer, and I was a do-it-yourself investor, perhaps like some of you in this room. And I explored different methods of investing. And so as an amateur, I guess I can say now I've graduated to become a professional, in terms of running my own practice. But I'm sharing that to say that it's because with that experience, the sharing that I'm going to do today with you, it's really based on a combination of my personal and professional experiences as an investor. And one thing I've learned over the years is that there is really no silver bullet in terms of an approach to investing. Everything has pros and cons, but some methods are better than others. And given we have a wide range of audience tonight, I will start off with more basic concepts and move to more advanced ones. So let me just kick us off by answering some common questions. So the first and my favorite one is, what are the secrets to building wealth? And I often get this from Uber drivers once they find out what I do for work. And my answer is, when I find them, I'll be sure to let you know. Because I haven't found any great secrets, but I certainly can share with you some basics to building wealth. And the basics actually start with you and your good habits. So number 1, start early to harness the power of compounding. Number 2, spend less than you make, because wealth accumulation, as I said earlier, comes from your savings and your investment growth. You want to pay yourself first. And then lastly, it is certainly important to control cost in your investments, but it's also equally important to be able to balance between cost. Some people consider it as management expense ratio, MER, and the services that you're getting. So then number 2 becomes, okay, given this context, what's the right investment approach for me? So here I want to share with you 3 common approaches that I normally come across with people in conversations, and the factors that are important to consider. The first approach is do it yourself. So this means you're buying maybe stocks, ETFs on a discount brokerage platform that you are managing your own portfolio. You are your portfolio manager. Method number 2 is you go into the banks that you work with, you hand over the money and you buy the mutual funds that they offer to you. So these are bank-owned products, mostly mutual funds. Number 3 is working with a holistic service firm like that of Richardson Wealth and giving someone like me a portfolio manager to manage your assets, as an example. And so if we look at the different factors that are important, we're just going to really focus on the top few here. In terms of cost, there's no doubt that doing it yourself is the lowest compared to the other two because you're not paying anyone to manage your assets. However, when it comes to time and opportunity cost, I would say that this is perhaps the most important factor for many people in the room tonight because we are busy professionals trying to balance our careers, family, hobbies, everything else. So if you want to do it yourself, it is, I would call it high considered relative to the other two methods. And I can tell you that I can relate to this because I have someone at home who is kind of in this situation. My spouse is a cardiologist, so I've seen the lifestyle of what it means to be a doctor or a dentist, I guess, in this example. So then you might say to me, well, I am just a passive investor. I just buy, ETF stocks and I just leave them there. I don't look at them. So it's not a high commitment for me. Well, then I say to you, if that's your scenario, then you take the risk of running potentially very high stress during market dislocations, which I will go in a bit later on. So effectively doing it yourself, you have high in these categories versus low because you're effectively outsourcing wealth management in these two columns. And then fourth is when you're investing on your own or you're generally working with the retail banks, you are really just getting the investment pillar of the three. Whereas with a holistic wealth service, you can expect to have all three pillars of services. So I would argue that for the people in this audience, that working with a retail bank is not the most optimal solution. So then we're left with really do-it-yourself and holistic services. So let's dive in a little bit into each of these. If you were to choose one of these paths, what would you look for? If you're doing it yourself, you have to expect that you're going to incur trading cost. This is usually dollars per trade as you're putting on trades in the discount brokerage, plus the MER of the solutions you're using. You're really just focusing on investments and you are your own portfolio manager. If you choose to go down the path of holistic wealth services, you are going to be paying a management fee to your advisor. So that usually is a percentage of the assets that are being managed, plus the MER of the underlying solutions that are being used. However, in return, you get access to all three pillars of services. And then in terms of qualification, actually, before I move on, I do want to highlight that when I say tax and estate planning, as a group, my firm, we provide guidance in the planning, but when it comes to implementation, we actually rely on people like Kenneth and Richard to do the actual implementation of the accounting aspect. So there's a little distinction there. Now, moving on to qualification, the first thing I want you to know is that portfolio manager is not a corporate title. It doesn't mean I'm the manager of the office or something like that. It actually signifies the highest level of licensing in the investment industry. It is only portfolio managers that have fiduciary duty to act in the best interest of their clients, meaning managing their money and acting in their best interest, just like doctors, dentists, and lawyers would. And so the analogy I like to use is if you choose this path and you work with a portfolio manager, you hand over the authority for them to manage your assets. And if so effectively, they are the pilot on an airplane and you are the passenger. Their job is to deliver you to your retirement destination under fiduciary duty. Now, in terms of designations of what to look for, you might come across something called the CFA, which is the Chartered Financial Analyst, which is for investments, or something called the CIM, which is a lighter version of the CFA. You might also come across the CFP, which is for financial planning, as well as the CLU, which is for life insurance. It's life underwriter. I want to give you a bit of color on the CFA because there's usually some confusion in terms of what it is. First of all, it is not the accounting designations like the CA or the CPA that both Richard and Kenneth have. The CFA is really specific to investments. It's considered the gold standard in the investment industry. In short, it requires about 10,000 hours of training in terms of exams, studying to be able to achieve this designation. And so I would say then in summary, if you are a do-it-yourself investor and you want to consider holistic wealth services, it's really three triggers. I would say that trigger this kind of graduation or path is when your portfolio gets bigger, because there is a certain minimum investable assets threshold to go into this type of setup. So if your portfolio is getting bigger, if your family situation becomes more complex, where you need to leverage all three of these strategies, as well as the fact that you're just too busy and you don't have the time to manage your own portfolio. So then another common question I get is from people is, they tell me I'm running my own portfolio. I love, my stocks. I love my ETFs. I love controlling the cost. The markets are doing well. What is the risk of doing this? So it's working well, but what could be the risk of a passive buy and hold strategy? Really, the biggest risk is prolonged wealth destruction, because as you can see here, an all equity portfolio can lose up to 50% or more of its value over time. So what I've shown you here is 4 episodes of market crashes over the last 100 years. And I can share with you that I started investing as a student right around the tech bubble. So personally, I've experienced 2 of the 4 episodes. And let me tell you, I didn't have a lot of money to lose, but it was not fun mentally to go through these types of cycles. So this is something you need to be aware of. And this is the consequence of passive, because nothing comes for free in investing. Now, you might tell me, well, I don't care, because if the market drops 50%, I'm just going to buy more. And I would agree with you if you're young and if you're still working, because the entry is easy, meaning it's easy to buy, but the exit can be hard. Meaning, what happens if one of these episodes happen when you are close to or when you're in retirement? What will happen then? So that is the big question. And one of the interesting thing is you realize when you observe these dates, these big events happen kind of decades apart. So it's really long enough such that investors begin to forget what can happen in the markets. And usually the younger investors become complacent in the market. And then over time, something like this can happen to them. So with that said, I want to now pivot and show you something different. So with all that said, you might ask, okay, is there potentially a better approach to investing? How do institutions invest? So now I want to share with you a more advanced approach to investing. Something that endowment funds like Harvard and Yale, they use this method. And it's the same approach that my team uses to currently manage over $300 million of client assets. So here's an example of an institutional caliber portfolio. The first thing you'll see that it has many different slices to the pie, and not just stocks and bonds. And so I first came across this approach in one of my MBA classes where I was exposed to this idea. And in my experience, I have to say that this is one of the most steady and highest probability of long-term success in terms of an approach. So let me just kind of guide us through this approach and the different assets that we're looking at. So many people actually know about what's on the left side of the circle because they might own a home. They might even have an investment property, so real estate is familiar to them. They might know about stocks and bonds because they hear it in the news. They invest in their TFSA, RSP, etc. But what they don't know about for many people, or nor do they have access to, is what's on the right side of the circle. So I'm going to give you a preview of what they are in a bit. So in fact, generally speaking, if you go into a bank, let's say if you go into a retail bank and you purchase mutual funds or you sometimes even ETFs, for the most part, you're only given access to these 2 slices. Whereas institutions and us, as portfolio managers, we have access to many more asset classes. This is not all the asset classes that exist out there in the universe, but it shows a good representation. And so the idea is we want to be able to create globally diversified multi-asset portfolios. We want to spread your money around in different assets that give us different return and risk profiles. So now let me give you a brief description of each. For those who are business owners, you're a partner in a law firm, or you own your own medical corp, well, you actually have private equity because you own a part of a business that is not listed on a stock exchange. So that is a form of private equity. Preferred shares is a type of security that sits between stocks and bonds in terms of a capital structure. They are less risky than stocks, but more risky than bonds. Generally, you hold them for dividends. And then you have hedge funds that come in two forms. One can be growthy, others can be a hedge against a market so that you can hedge out the market risk, you can even hedge out interest rate risk. And then lastly, we have commodities. So as you might have heard, like gold, silver have done really well in the last year or so. So that would be a form of hedge against market risk as well as inflation. So the takeaway really from this slide is that there are many different assets out there that you can use for smarter diversification, and institutions know this. So I want to show you the asset mix for the Harvard Endowment Fund. So you'll see right away that they do have many different slices to the pie, not just stocks and bonds. And in fact, since I've been tracking them for the last 8 to 10 years, what's been interesting is that their equity exposure, meaning their public stock exposure, has decreased almost every year. They're only holding about 14% now. In fact, they have a much bigger exposure in hedge funds and private equity. Private equity is special because they are less liquid, but they can give you higher returns. So generally speaking, an institution like Harvard, which has a 100-year plus time horizon, can take on this type of illiquidity profile. So that's why they're doing what they're doing. For us, however, in comparison, I want to show you two of the commonly used models that we run, the balance and the balance growth. You also see that we have different assets, but we don't have private equity. Currently, we did have it in the past, but currently we choose to not to have it because public markets have been doing better. So that's not an allocation that we're using. But in summary, you can see that overall, we have about maybe, let's call it 60% to two-thirds in stocks and bonds, and the rest of the money for our clients are spread into other assets to provide diversification. Now, this type of portfolio construction technique is very defensive by nature. I'll give you an example. For this particular model, during 2022, when the markets fell about 20% from peak to trough, this particular model dropped only about 7%. So about 1/3 to 40, let's call it 1/3 of the market's drop. And then in the last 3 years, from 2023 to 2025, this model averaged about 12% per year after fees. So it protected capital and gave growth when the environment supported growth. So by default, we're playing defense. And then when the market allows us the opportunity, it is my job as a portfolio manager to take on risk on behalf of our clients by moving capital around these different slices. So now I want to give you a couple examples of what we call tactical active trading. So here I have a 1-year chart of a global ETF called XEQT. Let's ignore all the fancy lines, but what I just want to say is that each bar is 1 day. So this is like a daily chart. What we managed to do was during the kind of the tariff turmoil, the big drawdown of the spring of 2025, we initiated a position in XEQT on April the 7th, very close to the market bottom. And we were able to capture this opportunity by riding this position for about 6 months before exiting in October to give us a 30+% gain. So this is really just one example. And the reason why we're able to do this is because we act on behalf of our clients to monitor the markets every day to look for such opportunities. And then in December of 2025, we increased our position weights in energy. And that's an ongoing trade that is currently doing very well because of the Middle East crisis and conflict. So as of today, I'm happy to say that our 70-30 portfolio that I showed you is still up about 2% year to date, while the S&P and the NASDAQ are down about 2 to 3%. So we're certainly holding on better than the markets, the broad markets. So I want to just bring you back to the big picture, and you might ask why do institutions invest the way they do? So I want to give you one example to bring it home. And here's an example that shows how volatility and big drawdowns can hurt long-term wealth accumulation. So here we have two friends, Consistent Christine, the Christine that Richard mentioned, and her friend Jumpy Jeff. Christine gets 8% a year for the next 10 years. So very steady returns, and some might call this boring, but she's steady. Jumpy Jeff loves excitement and he wants the growth portfolio. So in fact, he does pretty well. He gets 20% for the most part, except for 3 negative years. In fact, after the first 2 years, he is well ahead of Christine. And if we were to take the 10 years, add them all up and divide by 10, it's actually a tide in terms of a simple average, meaning there's no compounding involved. It's just a tide. So now let's see what happens when we actually take their principal amount and compound through time. It turns out that if we consider compounding through time, Consistent Christine actually comes out ahead of Jumpy Jeff by more than 300K. So let that sink in for a minute. The math shows us that consistency is very powerful because big drawdowns like this hurt long-term wealth creation. And this is very true, especially true if drawdowns that are, the market crash type happen close to or in your retirement. So the takeaway is we want to be able to control volatility if possible and and enjoy consistency through portfolio construction that gives us defensive natures. So now I want to pivot to the third pillar, and I will invite Richard back in shortly. But first, let me just give you a quick overview of protection strategies. So when Richard and I think about and talk about protection, we're really thinking about, protecting you and your family from the unthinkable. So generally speaking, there are different types of insurance, and the more common ones that you might hear about is disability insurance. This gives you income protection if one is disabled and can't work. You also have critical illness insurance, which pays out a lump sum if you're diagnosed with a severe and life-threatening illness. And then when it comes to life insurance, there are two broad categories. There's term life, which really only gives you coverage during a specified period, like say 10, 20 years, and it pays you a death benefit only during the coverage period. The advantage of this is that the premiums are very cost effective. Whereas permanent life, it guarantees lifetime coverage and a guarantee paid out upon death, but premiums tend to be higher because of a cash value. An analogy I like to use is that term life is like renting a home. Once you leave, you have no equity, whereas permanent life gives you equity buildup. So by the end of the policy, you have equity in the home. So we're actually going to dive a little bit more into permanent life because it really combines lifetime protection and tax-efficient growth and wealth transfer. So it can be owned personally and corporately. Richard can certainly talk more about that. It builds cash value in a tax-deferred growth manner. It allows you to borrow against the policy for liquidity if you ever need it. And the most important part is that it pays out the death benefit tax-free directly to your beneficiaries or through your corporation's capital dividend account. And so really the takeaway here is that it can be a very powerful tax and estate planning tool that allows your family to keep more wealth and increase your estate value to the next generation. So Richard, I'd love to invite you back in and provide more context for this type of strategy.
Okay, thank you very much for the informative session, Ethan. As Ethan mentioned, the permanent life insurance is just another tool for tax planning. As Kenneth mentioned, when your investment income hits 50K, you start losing the $500,000 worth of, the small business limit. However, the growth of the investment component in the permanent life policy does not get counted towards that that 50K. So that's one benefit. And for some business owners, they'd be like, well, my cash is stuck in there. Well, a way to get around this is to use this permanent life policy as collateral. So you would take an offsetting loan, and this loan can be in the business to fund operations or even a personal loan. And in which case, when the insured person passes away, the loan would pay off from the proceeds first. And another big takeaway is passing funds to the next generation, because when a shareholder passes away, there is double taxation, both when you take money out of the corporation, and again, because whenever someone passes away, there's capital gains on their assets. So when the policy flows out the proceeds tax-free, it allows it to go tax-free to the next generation. I do want to point out that this is only suitable for those who have a bit of excess cash, since the premiums are quite high and there's less flexibility. Like, you can't just simply sell it and walk away like you would, if you had other investments. Do you have anything else you want to add, Kenneth or Ethan, to this?
No, I think that's good because I mean, in insurance, there's so much to it, and they can get very complicated. But I hope that gives everybody a good general sense of how life insurance can be used, for tax planning purposes and also for investment strategy as well.
I agree. I think if I was to take us back to the kind of the holistic wealth and the teamwork that I talked about, it's really surrounding yourself with different professionals, different experts, so that because when we work with our clients, we certainly bring in like, the Richards and the Kenneth and like the lawyers to come in, because it's really a team that solves and, generates these types of strategies, because we need to consider it from all perspectives.
So this allows someone like Christine to protect, between the types of investments we've kind of helped her reduce tax, invest, and now the final piece would be to protect herself against the unthinkable and hopefully to pass it on to the next generation.
That's great. Just wanted to see if anyone online has any questions. Feel free to unmute as well. Hopefully you haven't fallen asleep yet. Okay, it looks like there isn't any more questions. So I just wanted to say that our contact information, our emails, phone numbers are there for you to take note, and our websites as well. So if you have any questions, please feel free to reach out to us. And one thing I do want to extend as an invitation is that I've created a financial health assessment for people who are curious about their own financial health. So if that is of interest to you, please get in touch with me, and I'll be happy to walk you through a complimentary financial health assessment in which we'll look through many of the different aspects of the 3 pillars.
And
So
likewise, Kenneth and I are, if you have any questions, you have questions about your own tax and accounting situation, please feel free to reach out to us as well.
Great, everyone. Thank you so much for spending your evening with us. We really appreciate it, and we hope that we were able to add a few more tools to your kit, at least as for consideration, whether it's now or for the future.
Thank you very much.
Thank you, everyone.
Good night.
Thank you. Good night.
Good night.
Thank you.